Dollar yen daily forecast July 13, fxempire.com. Dollar yen pair fell during the session. It did test the 80 level though, so the tone, of course, was pretty soft for risk-based assets around the world, as this pair tends to follow risk-based assets, as the yen is probably a little bit more of a safety trade than the dollar. It doesn't surprise us that it fell. It still looks to us as the 80 handle is the area that it's trying to break out of, but in order to get really convinced of a bullish run, we need to see the 80.60 level taken over. It's a new high, essentially, is what we're looking for. 79 continues to hold as support, and below that, the Bank of Japan sits, and because of that, we are not willing to short this market. However, if we do see an acceleration to the downside, any supportive action near the 78 handle gets interesting for us, and we are willing to buy supportive candles. So we have a buy or wait and buy situation, either post 80.60 or right around the 78 handle on any signs of support. We are willing to go long. This pair is essentially a measurement between two central banks. One, the Bank of Japan, which we know is expanding its asset purchasing programs and such things in order to try to weaken the value of yen, and the Federal Reserve, which has been a little bit more opaque about what it's going to do. So having said that, we need to see what the Fed's going to do, and this will be a headline-driven market certainly, as if the Fed announces easing, this pair will fall. But if they continue to be kind of non-committal about it, eventually this pair will rise. And certainly, over the long run, it does look like the Fed is probably closer to raising interest rates than the Bank of Japan, although let's be honest, neither are really that close to it. This pair will eventually, once it's above 80.60, become a nice long-term trade. Above there, we look for 84, and above 84, it could be an ultra long-term trade that you're in for months, if not years, like we would have been probably 4.5 years ago.